Hey everyone, welcome back to the channel. Today we're re-tackling the biggest investment question facing Americans in 2026. Should you invest in real estate or the stock market? This isn't just theory, this is about your financial future. And I'm going to give you the hard data, the real numbers, and the actual strategy you need. Let us start with a shocking statistic that might surprise you. If you had invested $153,500 in an average home back in 1995, it would be worth about $504,000 today. Sounds good, right? But here's the kicker. That same $153,500 invested in the S&P 500 would have grown to over $3.4 million. That's nearly 7 times more wealth from stocks. But before you dismiss real estate entirely, we need to talk about the whole picture. Because this comparison doesn't include rental income, tax benefits, or the power of leverage that makes real estate so attractive. Let us look at where we are right now in 2025 heading into 2026. The stock market has been absolutely crushing it. The S&P 500 returned 23.3% in 2024 and is already up another 14.6% in 2025 as of mid-December. That's 2 consecutive years with returns over 20%. Something we haven't seen since the late 1990s. Historically, stocks deliver about 10.6% annual returns on average. Now flip to real estate. The average U.S. home value is currently $360,727, and the median existing home price hit a record $435,300 in June 2025. Let's talk about money, the actual dollars you need to get started. Now compare that to stocks. You can literally start investing with $1 today thanks to fractional shares. With $100, you can buy into an S&P 500 index fund. With $1,000, you can build a diversified portfolio. Your ongoing costs: almost nothing. No maintenance, no surprise repairs, no tenant calling you at 2 a.m. Let's dig into returns. Over the past 32 years, stocks returned 10.4% annually versus real estate's 5.5%. Bet. Real estate investors will tell you this doesn't show the complete picture, and they're right. When you add rental income, which can yield 4 to 8% annually, the picture changes. And here's where real estate gets its superpower leverage. With an $82,000 down payment on a $410,000 property. If that property appreciates just 5%, that's a $20,500 gain. Your return on your actual $82,000 investment is 25%. But we have to subtract real costs to get the truth. Property management, maintenance, vacancy periods, and taxes. After all these costs, your realistic net return is more like 4 to 8%. Compare that to the stock market's simpler math. The S&P 500 has delivered an average annual return of 10.6% with no maintenance or tenant calls. If you invested $100,000 in stocks over 30 years at 10% returns, you'd have over $1.7 million. That same $100,000 in real estate at 8% total returns would give you just over $1 million. The stock market wins on pure returns. Let's talk about risk. Stock markets have high short-term volatility. They can drop 20 to 30% in a single year. But here's the data that matters. Over any 20-year period, the S&P 500 has never had negative returns. Long-term investors almost always profit. Real estate seems safer, but it has hidden risks. Concentration risk means all your eggs are in one basket. Tenant problems can cost thousands, and unexpected repairs like a new roof for $15,000 can hit at any time. Liquidity is crucial. With stocks, you have ultra-liquidity. You can sell shares in seconds. Real estate is the opposite, highly liquid. Selling a house can take 2 to 5 months minimum, and you'll lose 5 to 6% to transaction costs. That's $20,000 to $24,000 on a $400,000 property. But this illiquidity creates discipline, preventing you from panic selling. Time and effort is where these investments dramatically differ. For stock market investors using index funds, it takes 30 minutes to set up and maybe an hour a year to rebalance. It can be 100% passive. Real estate, on the other hand, is a part-time job. You're screening tenants, handling repairs, collecting rent, and doing paperwork. Hiring a manager helps, but it costs 8 to 10% of your rental income. Now for the fun part. Tax advantages. Real estate has powerful tax benefits. You can deduct mortgage interest, property taxes, and maintenance. And here's the magic: depreciation. You can deduct over $14,000 a year on a $400,000 property, creating a paper loss that shields your rental income from taxes. You can also use a 1031 exchange to defer capital gains taxes indefinitely. The stock market's tax benefits are different, but still powerful. If you hold stocks for over a year, you pay a much lower capital gains tax rate. What about diversification? With stocks, you get instant diversification. One share of an S&P 500 index fund gives you ownership in 500 of the biggest companies. With real estate, you're tied to one property in one location. To truly diversify, you need to buy multiple properties, which requires millions of dollars. There is a middle ground: REITs, or real estate investment trusts. These are companies that own real estate, and you can buy shares of them just like a stock. You get professional management, diversification, and high liquidity. REITs have historically delivered returns very similar to the S&P 500. It's a way to get real estate exposure without the headaches of being a landlord. So, who should choose what? Choose real estate if you have significant capital, want leverage, don't mind being hands-on, and plan to hold for 10+ years. Choose stocks if you're starting with less capital, want passive investing, value liquidity, and want instant diversification. But here's the truth: you don't have to choose. The smart approach for most people involves both. Here's a roadmap. From age 20 to 35, build your foundation with stocks. Max out your 401k and Roth IRA from 35 to 50. Expand your portfolio. Continue stock investing and consider adding a rental property or REITs. From age 50 onward, shift towards income generation with dividend stocks, bonds, and your rental income. Let me give you a practical example. Say you take home $5,000 a month. You could put $500 into your 401k, $583 to max your Roth IRA, and save $500 for a real estate down payment. In 10 years, your stock portfolio would be worth around $200,000, and you'd have $80,000 ready for your first rental property. This is how you build real wealth. Avoid common mistakes. For real estate, don't buy with less than 20% down, and don't underestimate maintenance costs. For stocks, never panic sell during dips, and don't try to time the market. Diversify with low-cost index funds. So what's the final verdict for 2026? Start with stocks. They are accessible, liquid, and historically superior for long-term growth. Add real estate later when you have the capital and time. Or use REITs for passive exposure. The best investment isn't property or stocks, it's property and stocks. So here's what I want you to do. If you're starting out, open a brokerage account today. It takes 10 minutes. Buy a low-cost index fund like VTI or VU and set up automatic investments. View. Ready for real estate? Get pre-approved for a mortgage and start researching markets. The path to wealth is about consistent, disciplined investing over decades. If you found this video helpful, smash that like button, subscribe, and drop a comment telling me if you're team stocks, team real estate, or team both. I read every single comment. Now stop watching YouTube and go start investing. Your future millionaire self will thank you. I'll see you in the next video.